Here are the top 5 indicators you can monitor if you're worried about the stock market being overvalued and at risk of crash. Check on them monthly to keep your portfolio safe and prepare yourself to take advantage of the next downturn. The first indicator is margin debt to S&P 500. Margin debt is the money investors borrow from their broker to invest. It's a loan. Brokers can demand repayment at any time. When stock prices are going up, it's not a problem. In fact, as stock prices increase, investors can borrow more, pushing prices up even further. But when stock prices decline, the opposite happens. Prices decline, brokers demand repayment, investors sell the stock to get cash, which makes prices decline even further. High margin debt equals a more fragile stock market, and a more fragile stock market equals more risk of a crash. Today, margin debt levels are at record highs. You can see the changes in margin debt levels are correlated with stock prices from the chart. It's a feedback loop. When margin debt levels are low, investors have a lot of buying potential to fuel the next bull market. But when they're at record highs, like now, it's time to be careful. There's a limit to how much brokers can lend and how much investors can borrow. Like a rubber band, the more it stretches, the more likely it is to snap back. That's the first indicator, margin debt. The next one, the Buffett ratio. The Buffett ratio compares the total market capitalization, the value of all stocks, to GDP. In 2001, Warren Buffett called it probably the single best measure of where valuations stand at any given moment. Why is this such a good measure? Because the value of all businesses cannot vastly exceed their total output. There might be some businesses where the growth prospects are so monumental, investors are willing to pay significantly more than current revenue. But on average, this is not true. As you can see from the chart, valuations are more than 200% of GDP, well above the long-term average. Another way to think about this is that if stock prices decline around 50%, they would only get back to the average. Markets tend to be mean reverting. So either GDP must increase, stock prices must decrease, or some combination of the two. That's indicator number 2, the Buffett ratio. The next one, the Shiller price to earnings ratio. The Shiller P ratio compares the S&P 500's current price to its average inflation adjusted earnings over the last 10 years. This metric smooths out the volatility of earnings and compares valuations to real earnings capacity over time. It works because earnings drive long-term stock valuations. What you can see from the chart is that valuations are considerably above the long-term average. Currently, the Shiller P ratio is around 40 times and the average is 16 times. Unless earnings increase significantly enough to increase the overall average, which is unlikely, the most probable way this metric reverts to the mean is stock prices declining significantly. And that's the third indicator, the Shiller P ratio. So far, we looked at metrics that track leverage, revenue, and earnings. Next is the Q ratio. Quick pause. If you find this information useful, subscribe so you don't miss the next one. Indicator number 4, the Q ratio. The Q ratio is less common than other metrics, but it's valuable because it looks at something different, the balance sheet rather than earnings or revenue. The Q ratio compares market value to the replacement cost of assets. If you can buy a business for less than a cost to replace everything it owns, it's likely to be undervalued. More than replacement cost, potentially overvalued. The Q ratio is currently at double its historical average. Okay, so that's where indicator number 4, the Q ratio. And finally, number 5, the 2-10 yield curve. The 2-10 yield curve spread measures the difference between the yield on the 2-year Treasury bond and the yield on the 10-year Treasury bond. The yield on a bond is a measure of how much interest the bond pays relative to its price. If a bond's price goes up, its yield goes down. Like stocks, investor demand affects the prices of bonds. This isn't a direct stock market valuation metric, but it matters because it reliably predicts U.S. recessions. Normally, 10-year bonds pay higher than 2-year bonds. Makes sense. You should get paid more to lend money for longer. But when investors expect a recession and interest rates to be cut, they buy longer-term bonds to lock in rates today before they drop. That pushes down long-term yields. When the curve inverts like it did in 2024, 2-year yields are higher than 10-year yields. It's been a reliable indicator of recession. So how should you use these metrics? The way to consider these metrics is like a thermometer. A thermometer can tell you that it is hot, In the same way, these indicators can tell you how high valuations are above their long-term averages. They can give you insight into how risky stocks are right now if debt is high and investors are expecting a recession. What they cannot tell you is when these factors will come to a head. A thermometer tells you that it is hot, not that it's about to be cold. This is an important distinction. During high valuations, valuations can keep going higher. Investors start to hear about others making money, they get FOMO, and they jump in. The problem is that markets do tend to revert to the mean. So what do you do with this information? When markets are highly priced and risky, you as an investor need to be more cautious. Hold more cash, buy companies that are financially strong, study them well, diversify. It's not only about sit around and wait, although that is part of it. You can prepare for when times are good to invest, when prices are lower and opportunities greater. This is how great investors behave. Warren Buffett has over $1 trillion of assets in his company, and almost 30% of that is cash right now. You think about that. Okay, so check on these 5 indicators regularly. They'll give you a clear picture of where valuations stand and how much risk is in the market. Right now, all 5 are signaling record high valuations and elevated risk. Being cautious makes sense. Check the links in the comments to see for yourself. If you found this helpful, subscribe for more content like this, and let me know in the comments which indicator you'll start tracking first. Hi, I'm Charles. I don't like most investing and finance content I see online. It's typically designed to sell you something. You don't need to buy anything from me. This content is for educational and entertainment purposes only. Seek professional advice for your situation. I want to make financial freedom accessible for the average person. Profit is desirable, ownership is freedom. Good luck and goodbye.